Hello and welcome to Options in Plain English. Today we're going to be talking about a long put, and in particular, we're going to be analyzing the risk profile of a long put. On this graph, we can see that if we buy a put, which is indicated by this circle with a P, when you buy it, you're going to be paying a certain amount, and that amount is going to be the option premium. So before we can actually start making money with the put, we need to get over that option price that we already paid for it, which is why we have a break even that is lower than the strike price where we sold the put at. So basically for this graph, if we have an underlying that's trading at a certain price, which is here at ATM, meaning at the money, and we buy a put at strike price K, the put is going to start gaining value as the stock starts going down, and once it goes above the strike price, it's going to start making money, and once it goes above the price at which it offsets the original price paid for it, the price paid for the put, is going to start now creating pure profit for the put holder. So if we look at this, we have the structure for this trade, which is going to be buying, so being long one contract of an out of the money. Later on, we're going to see what out of the money means, but basically for puts, it means a strike price that is below the where the stock or where the underlying is currently trading at. So it is buying a put at a strike price of K, and that's the structure. It's a very simple structure, just buying a put. The max profit is going to be unlimited, although in reality the stock can only go down to zero. So even though it's unlimited, meaning it's a pretty big number, it's actually bound by zero, which is unlike the call example, where the call itself, when you buy a call, it can go theoretically at least to infinity, so it's unlimited. In this case, although it is a pretty big number, the actual amount of money that you can make as profit is limited to the price being zero, which is going as low as it can go. But still, it's considered an unlimited because it's supposed to be a pretty big number, and it's not bound by anything else, only by zero. The max loss that you have when you buy a put is the price you paid for the put. So in this case, we're calling it P. So if, for example, you have a stock trading at $100 and you buy the $90 put and you pay $3 for it, those $3 is the maximum amount that you can lose. And you can see here, it doesn't matter how high it goes, your loss is going to be limited by the premium that you paid. Our break-even number for a long put is going to be the strike price minus, because we're going to be moving to the left, minus the premium that was paid. And at that point, anything below that is going to be profit, and anything above that is going to be loss. And of course, even though it looks as if this strategy does make or has a pretty big area where it loses money, you can tell that even though it loses money, it always loses a little bit, just the premium that was paid. Whereas it could make a lot of money because there is no limit once you go past the break-even point on the downside. So just like we did with calls, the solid line in this case represents the value at expiration, and the dashed line represents the value at any point prior to expiration. This line is going to be changing day by day because the probability of the put making money is going to be changing day by day because there's a different number of days remaining until it expires, and because the put's value is dependent on how many days there are still to go until expiration, the value of the put is going to be changing, and with it is going to be modifying this curve representing the profit at a certain point in time. So now let's take a look at an example so that we can see how these numbers play out in a somewhat real life example. So to initiate this trade, you buy a put at strike price K, which is going to be at a strike price below the price that it's currently trading at in the money or in the market. So let's assume that the underlying is trading currently at $50, and we buy a strike price of 45. We buy a put for a certain number of days, and we pay $2 for it. So our break even is going to be the strike price making money, which is going to be below the strike price, and then offsetting the $2 that we paid. So $43 is going to be our break even. So if the underlying expires below 43, we're going to be making money, and if it expires above 43, we're going to be losing money, which is why it's in the red area. Now, what will happen if, let's say, the underlying expires at $30? So we have the current price being 50. We buy the $45 put. We pay $2 for it, and the underlying price ends up being $30. So at expiration, if you have the underlying going to $30, your profit and loss is going to be the $45, which is the strike price, minus the $30, which is where the price ended up at. So a total of $15 difference, but you have to deduct the premium that you paid for the put. So that would be 45 minus 30 minus 2. So you would have a total profit of $13. So you bought something for $2 and you can sell it out at $15. You make a total profit of $13. And it's not a bad deal, because even though the price went down 40%, your profit was pretty much 6 times what you put in. So just around the 600% profit. So this is how we can see that that options carry a lot of leverage, and it's a good way for a retail trader, for any trader, to gain exposure to the market and do it in a very leveraged way, so that you can take positions that you wouldn't be able to if you didn't have these types of instruments, of financial instruments, at your disposal. Now we're going to be going to our actual trading platform, and we'll take a look at a real example over there. And now we're going to actually try to find an example with real data, so you can see how options work, how put options work in real underlying. In this case, we're going to be looking at the underlying for the stock of Disney. In this case, this is the price of Disney, and it's been trading at all over the place, but basically right now it's trading at $104. So if we come here and we have all these alternatives or all these options for the expiration date, this time I'm going to go a little bit closer. So I'm going to go to the 20 days to expiration, so you can see how that one works as well. Remember, you can pick whatever it is that you want. You can in this case you can go all the way up to June of 22, so over 2 years in the future. But we're gonna pick the one with 20 days. So in this case, the price is $140, and we're going to buy the $100 strike price, the put for the $100 strike price. So I'm buying one contract covering 100 shares of Disney, and it's the 1st of May of 2020. That's the expiration. So it's 20 days in the future. The $100 put, we're going to pay $390 for it. And let's analyze a little bit of the information here. So when we try to buy it, we can see this is the order confirmation. I'm using Thinkorswim, but your broker might show it in a different way, but it's going to be pretty much the same information. You're buying one contract of Disney, and it covers 100 shares. The expiration is not a monthly one, it's a weekly. Later on, we're going to see what that means. Basically, for us right now, it makes no difference. It expires on the 1st of May, so it's 20 days in the future. It's a put, and we're going to be paying $3.90 to open. Our break even is going to be, of course, the $100 strike minus what we paid for it. So we need the price to go to $96.10. The max profit is, assuming we go to zero, which is basically $9,610, which is what I was saying. For practical purposes, we're talking about an unlimited profit potential. But in reality, it's only when you're buying a put and you're betting on the downside, the most you can make is the stock going to zero. The max loss is what we paid for it. So $390, 100 shares that one contract is covering, we're going to be paying $390 times 100, $390. Transaction fees, buying power effect, and this is going to be dependent on your particular account. So now let's analyze it. So I was saying before, we're using Thinkorswim's Analyze, the Thinkorswim's Analyze tab, and we're going to analyze what this trade is all about. So we have the $100 strike price, the put. So any price, this blue line, this light blue line, is going to be the price at expiration, and this purple line is going to be the price right now. So if right now price starts going down, we're going to be starting to profit, and we're going to profit more the lower it goes. And at expiration, we're going to have the blue line. So this is going to be our final profit if we hold on to the option all the way to expiration. Remember, you can always sell it prior to expiration. As a rule of thumb, we usually don't exercise options. We only buy them and sell them on the market. So if we start analyzing this, and we can see that if today, what would happen? Well, first of all, let's figure out the break-even point. So this is the break-even point at expiration, which is a very important characteristic and a very important parameter of your trade, of your strategy. So we know that we paid $390 for this put. So our price needs to go at least to 100 minus 390. So let's figure it out here. So this is our break even, and we're gonna take a look at it to see it visually where it is on our price graph. Okay, so we have it right here. The price is currently at this level at $140, 140.50, and we bought the $100 put right here, and it's going to be profitable at expiration if it goes below this line. So we're betting that this price is going to go lower than this. But remember, if the price starts going down before expiration, then you might have a different break even. In fact, for example, right now, if price starts going down, let's say it goes to $98, or actually not even to expiration, to below the strike price. Let's say it goes to $102. Even at this point, you're going to be making money. Why? Because there's still some time to go. So the put option now, not only is it closer to the strike price, but there's still a whole long period of time to go, so it could go even lower. That's why it gains value, and we can start making money right away. We don't need to go beyond, or in this case below, the strike price. We can make money if it starts going down in this case. Later on, we're going to analyze that if the stock becomes more volatile, we're also going to start making money. But this is something we're going to analyze in a more advanced lesson. So if it goes to $102 today, we're going to be making $85, give or take. And if it goes to 85, for example, so if it goes down a lot, we're going to be making just around $1,200. So we paid $390, and we're going to be making $1,200. So hugely profitable. Why? Because we got the direction right. We wanted the price to go down, and it went down by a lot. So we make money. This is how puts work. Now, let's analyze what happens as time passes. As I was telling you, this purple line is the line of today. So I'm going to simulate time passing. Okay? Look at the purple line, how it's going to be approaching and ultimately merging with the blue line. This is a representation of the options time decay. So options, when you buy them, are a wasting asset, they're called, because they start losing value for each day that passes. Why? Because the probabilities of it making money are going to be going down, and this is represented here until we're at the April 30th point, and then expiration, it merges with the line. So you can see how time affects the risk profile. Now, also, what will happen if we use, as we did before, what will happen if we use the put option as a protection? We were talking about a protective put. So in this case, I'm going to simulate the purchase of 100 shares so that you can see what this strategy looks like. Okay, so right now we're at 104.5. So just about here. And as you can see now at expiration, it doesn't matter how low it goes. So our 100 shares are being protected by the contract, the put contract that we bought. And of course, we're going to have a max loss of the amount that we paid for. So right now, if I'm buying, let's say at the price that it closed at, 104.50, we're going to be losing $840. Why? Because it goes down the 450. So the price was here. We lose. The put option is not yet, hasn't kicked in yet. So we lose the 450, and then the loss stops. But we also have to add the premium that we paid for in the form of a put. So if we buy stock at 104.50 and it goes to 80, for example, or 85, then what's going to happen is we lose because we're not protected here. The put only kicks in at the 100. So we lose the 450 and then we don't lose anymore. But since we paid the 390 for it, we have a total loss of 450 and 390, which add up to $840. And this is how you can use the put as protection as well. This concludes the analysis of a put option and of its risk profile. So now you know more or less how puts work and how you can use them and what you can expect when you actually purchase one, either to profit on the downside or to protect existing holdings, or if you want to buy a stock and be protected on the downside. Thank you very much for your attention, and I hope to see you again next time. Goodbye.